Welcome to the Bullish Money YouTube channel. It is time for another unfiltered session. We have some very important news. First of all, I wanted to wish you guys well for this coming new year. I know we haven't talked in a while, and part of the reason why is I got this professional gig for, a professional setup for my recording. Okay, got a preamp, a mic preamp, plus Pro Tools software. Because I figured, you know what, if we're gonna get serious, let's go all the way serious with this endeavor. The problem is Pro Tools is a very finicky software. If any of you have experience with it, it's really great. I mean, the interface is awesome. I love Pro Tools. The problem is when things go bad, when things go wrong in Pro Tools, it goes wrong in such a severe magnitude. It's very difficult to figure out what exactly is going on. And so part of the problem was that I was trying to get this setup that I have to recognize, for Pro Tools to recognize my microphone. It simply wouldn't recognize my microphone. And what good is having a YouTube channel if you can't produce audio? And so finally I figured out this problem. It was a massive nightmare, but I got it figured out, and so we're ready to go. Now, the thing I want to hit up right now is the precious metals. So on Thursday last week, we had a price fixing controversy going on. And let me just give you a little background here. You have the spot price of silver, and then there is something called the silver price fix, which is set up by the London Bullion Market Association. And so the London price fix is what people trade basically on an auction setting to determine the price of the derivative markets. And of course, it's used as a benchmark for the spot price, but essentially the spot price is, quote unquote, the real value of silver. And the London price fix is what the 5 major banks that comprise this London Bullion Association, it's the price that they believe, the big banks believe, should be the contract price for silver, and specifically regarding the derivatives market. And so on Thursday there was this massive flash crash in the London price, and the London price, I think it dropped about 80 cents below that of the spot price of silver. Now, typically when you have this severe discrepancy, this discrepancy doesn't last long, meaning that when the London price fix drops, so too does the spot price of silver. But that didn't happen. The London price dropped rapidly, 80 cents below that of the spot price, but the spot price stayed relatively elevated, and it finally did drop a little bit, but it didn't drop to the same magnitude as that of the London price. So there was this huge exposure. I mean, we finally got to see the real inner workings of the silver market, and how there's this unique mechanism, so to speak, that determines the future, the forward price of silver. And I think there was one of the things that I, keyed in on was that there's really no news about this on the mainstream. You have to go literally to the alternative media. You got to go to places like SGT Bull, where he did an interview with David Morgan. And that's pretty much the only source. And I'm sure there's other sources as well, like at bullionvault.com. But aside from more alternative media, you really didn't hear this incident being reported by the mainstream media. It's almost as if it didn't happen, but of course it did happen, and it's causing a lot of confusion because of the regulations that have been imposed just recently, just last year, on the London Association. The traders that saw this discrepancy could not trade upon that information, meaning that they couldn't buy the silver at a lower price at the London price and then sell it at a higher price at spot price in another market. And so they were not allowed to advantage that arbitrage situation. That would have been a massive arbitrage situation. And I believe they have a point there. I think that, far be it for me or anyone else to agree with these jerk-offs. But in this case, I think there's a very valid point, because the arbitrage or the threat of arbitrage prevents these wild discrepancies from happening in the first place, meaning that there would be no incentive for anyone to artificially suppress the price of silver if all that is going to be accomplished is basically a wealth transfer from one entity to another. And I know that we don't really trust the big banks, but even the big banks, they have a profit incentive. I mean, they're not going to just reduce their own wealth to benefit that of a rival competitor. I mean, you have to understand that even within a conspiracy-minded perspective, people still have a greed, avarice incentive. People still want to make money, preferably at the expense of others. There's no such thing as altruism on Wall Street. And so the threat that arbitrage imposes when somebody, a big bank, for example, artificially suppresses the price of silver, there's going to be other banks, other traders that can see this and say, hey, I want in on that. That's free money. Well, the person that is suppressing, or the entity that is suppressing the price of silver, wouldn't want to offer that free arbitrage because they're basically giving away free money. And as we know, nobody on Wall Street gives away free money. So the threat of arbitrage is definitely a key component that was taken away when, ironically, the silver price market mechanism became regulated. What it is controlled opposition, and it's controlled information. And when you have controlled information, I mean, you can pretty much get away with murder. And that's essentially what's going on in the silver market. We'll be right back. I wanted to tie in the theme about supposed economic recovery with Amazon's latest earnings report. Now, a lot of people are looking at the jobs report and seeing nominal strength in the labor market, but they're not seeing wage growth. And personally, the families across America, they're not feeling that much wealthier. They're not feeling quote unquote recovered. They're just skating by. And certainly the opportunities in the labor market are very thin pickings. And it belies the information that is supposedly out there, that it belies the truth of the information that is being reported to us. And there are, however, certain pieces of information that pertain to the supposed economic recovery. And one of those stories is Amazon. Amazon had posted great earnings report and earnings result for the fourth quarter. And even though it sort of, it just a little bit missed the Wall Street consensus on earnings per share, it nevertheless posted a lot of strong metrics. One of them being a 22% increase in top line sales, about 26% if you adjust for currency fluctuations. And it posted massive net income, record net income, I think over $500 million. And overall for the year, it topped $100 billion in sales. So these are massive numbers. And of course, you see a 59% increase in membership for Amazon Prime. Overall, Amazon serves 300 million people globally. I mean, 300 million people, that's essentially the number of people that exist in the United States. So obviously Amazon has a huge chunk of that global e-retailer market share. And because their revenue is going higher, their earnings per share is moving higher, net income is moving higher, operating income, all of the good stuff is moving higher, one would naturally assume that Amazon is going to be the stock to buy for 2016. After all, in 2015, the share price more than doubled. So, that's a good 100% improvement for the investor's portfolio, whereas in the broad markets in the S&P 500, the benchmark index barely posted a break even. It was just basically at parity. And so when you look at Amazon, you're thinking, okay, they are the retailing company of the future. I mean, they've really got this whole digitalization aspect down to a science. And so this is a stock to buy. And not only that, but this is a stock that indicates that the consumer retail market, that consumer sentiment should be very, very strong as well. And I can appreciate that argument, and I don't necessarily disagree with all of the components, all the derivative components of that argument. But there's one cautionary note that I would like to issue regarding the supposed strength of Amazon's earnings report. And that is cannibalization. No matter how strong Amazon is, when you look at the broad retail market in the United States, you don't see a collective strength there. I mean, this is not something that lifts all boats. This is only something that lifted Amazon's boat, but everybody else is pretty much sinking. And when you look at the earnings, earnings that are adjusted for taxes, depreciation, interest, and amortization, when you look at the earnings, those adjusted earnings for Amazon, and you compare them to the same adjusted earnings for Walmart over the long-term historical period, you see a negative correlation. In fact, starting from the fiscal year ending 2009 until now, you see roughly a 39-40% negative correlation between adjusted earnings for Amazon and adjusted earnings for Walmart. And that should really clue you in as to the aspect to which I refer, the cannibalization. Because as Amazon moves higher, as this negative correlation indicates, Walmart, while it's not moving lower per se, it is decelerating sharply. So Amazon is accelerating sharply, Walmart is decelerating sharply, hence the negative correlation. Now, the negative correlation at 40%, it isn't exactly the strongest, at least from a mathematical perspective, it isn't the most strongest correlation. But when you look at the data, when you just do a line chart, you can see, indeed, there aesthetically appears to be a negative correlation, and mathematically, when you run a Pearson's correlation coefficient, it does show that there is some truth to the matter when you say that there is a negative correlation between those adjusted earnings between Amazon and Walmart. So I would argue from both a qualitative perspective as well as a quantitative perspective that there's indeed cannibalization going on. That the bottom line here is that while Amazon may move higher, Walmart at the same time is moving lower. And that should be concerning, because if we truly were in a robust economy, if the economy was growing in strength, both in terms of traditional metrics such as gross domestic product, and in terms of labor market growth, if we were truly strengthening in those key metrics, you would assume, logically speaking, that there would be growth broadly across major industries. And if consumer sentiment really was broadly improving, I don't think you would see this negative correlation at all between Amazon, which is, essentially the king of retailers, and Walmart, which is the king of the brick and mortar retailers. You wouldn't see that sharp of a negative correlation. In fact, the correlation should be flat. If the economy is really doing well, because they sort of service, different aspects of the economy, of the consumer market. I mean, yes, there's going to be some overlap there, but they tend to service different segments of society, and yet you see this sharp negative correlation. So that to me is a little bit worrying. What else is worrying is the technical aspect of Amazon dropping, I think it was 7 or 8% following that earnings report. I mean, it wasn't just because they technically missed the EPS consensus target by a little bit. It wasn't just that at all, because there's lots of companies that missed that margin missed that target by a wide margin, and yet their company shares don't drop 7-8% the next day. So while I believe that Amazon and Walmart are both very strong companies, regardless of this some of the near-term troubles that have affected the economy, I think the investors, the Wall Street insiders, are looking at the forward guidance. Operating income will be between $100 million at the low and $700 million at the high. So either you're going to see a 61% decline, or you're going to see nearly a 200% increase. I mean, what the shit is that? I mean, what kind of guidance is that? Basically, you're telling Wall Street, hey, we're going to do either really well or really poorly. I mean, who gives that kind of a guidance? I don't care that you're the CEO of one of the biggest companies in the world. You still don't give that kind of a spread on your guidance. You want to narrow it down, because when you have that big of a spread, it shows pretty much a lack of confidence. And I think that lack of confidence really contributed a majority of that 8% loss in the financial markets. But I think investors are also cluing in as to the real data of the economy. And I don't think that they like that cannibalization issue. I don't think that they like Walmart being gutted while Amazon is moving higher, because the net total essentially for US retail sales essentially flat year over year, if you see that kind of a cannibalization effect. And so I think that looking at the numbers from a purely non-emotional perspective, from someone that is not vested into Amazon's success or failure, I just have a lot of question marks. And I think that the conference call, the guidance, shows question marks within management. And I think that the media is just really not letting you in on what's going on. And it's very clear that they're not letting you in because of what happened in the silver market. I mean, this was a major issue, a paradigm shifting, breaking issue, and it was simply not reported in the mainstream media. So of course, they're not going to give you, if they're not going to give you a blatant truth regarding the commodity markets, they're certainly not going to give you the blatant truth when it comes to individual names, especially that these individual names that are doing well in recent times. These names are precious. They're precious few. And so there's an incentive to keep whatever strong names that are still technically strong to give whatever bullcrap reasons that they will continue to move higher. Sorry, I've been drinking a lot of coffee today, so I can't enunciate my words that well. But anyways, that really boils down to it. I think there's a lot of this. This is the year of bull crap. I mean, it's always been the year of bull crap, but I think this is. Oh man, this is some serious bullcrap, guys. I mean, this is some serious grade A bullshit that is going on in the financial markets. I say get your popcorn ready. This is going to be some serious entertainment.